In this lesson, we're going to introduce the balance sheet. The balance sheet is a financial statement that gives you a snapshot of what your assets are and then how you finance those assets. We finance assets with liabilities and equity. So you'll notice the right-hand side of the balance sheet, which is liabilities and equity, finances the left-hand side, which is assets. I'll also point out here that another word for liabilities is debt, and equity is the owner money. So we can borrow money and we can use our own money in order to finance the assets we have. Firms generally separate their assets into current assets and fixed assets. So current assets are going to be things like cash, accounts receivable, and inventory, which could be raw materials, it could be work in progress, or it could be finished goods. Long-term assets or net fixed assets are going to be things like plant, property, and equipment. It could also be patents, trademarks, and goodwill. Firms finance these assets with debt or liabilities as well as owner money or equity. Liabilities are also separated into current liabilities and long-term debt. Current liabilities include short-term loans, which could include revolving credit, or long-term loans, which could be bonds, could be long-term loans outstanding, could be mortgages on property. Equity, which is owner money. This could be common stock and additional paid-in capital that was paid by the owners when they first bought into the firm, or it can be accumulated retained earnings which the firm generated on its own and continued to reinvest in itself. One thing you'll notice throughout the semester is that firms make a lot of the same decisions that households make, and that includes how we finance our assets. So let's look at your balance sheet. Again, we'll start with the basic balance sheet equation, which is assets equals liabilities plus equity. So you also finance your assets with debt or liabilities and your own money or your own equity. Let's suppose that you've graduated college, you've been living with your parents, you've been saving and saving and saving, and you're ready to buy a home. You find a house you like, and you find that it's $250,000. So far, you've saved $25,000. So we're going to put that under equity because that's your money. It's going to take you a really long time to save those $250,000. So what you can do instead is use the $25,000 you have so far and a loan or a liability from the bank. So you can take out a mortgage loan from a bank or a mortgage broker, and your loan is going to come to $225,000. So notice that you've used $225,000 from liabilities or a loan and $25,000 of your own money, your equity. When you add those together, that gives you the $250,000 that you need to buy your asset or your house. So again, households use liabilities and equity, the right-hand side, to finance the left-hand side, our assets. The other thing you'll notice is that the balance sheet always balances. So assets has to equal liabilities and equity. Again, because the right-hand side finances the left-hand side. And just like a firm's balance sheet, your balance sheet here shows you a snapshot of what you have. You have a home for $250,000. And it shows you a snapshot of how you bought that home. You used debt of $225,000 and your own money of $25,000.